Crypto markets are manipulated. Yep, it's pretty clear that large players are fiddling prices to our detriment. The only question is, how much? Well, a recent report by crypto research firm Solidus Labs has some of the answers, and it tackles two of the biggest issues the crypto industry faces today: insider trading and wash trading. So, today we're going to summarize this report and tell you what it could mean for the crypto market. The report we'll be summarizing today is aptly titled, quote, "The 2023 Crypto Market Manipulation Report." It was published by Solidus Labs back in June, but it's safe to assume that its facts and figures haven't changed much since then. We'll leave a link to the report in the description if you're interested. Now, as hinted at in the introduction, the report is divided into two parts: insider trading and wash trading. So, the insider trading report begins with a brief introduction wherein the authors state the obvious. If crypto wants to see adoption, we need to know how much market manipulation there is and fix it. The authors also touch on the ETF filings we've seen over the last few months, and this is more significant than you think because one of the main reasons why the SEC hasn't approved these ETFs is because it believes that the crypto market is manipulated. Now, whether this is true for Bitcoin's BTC is up for debate, but when it comes to most altcoins, the science seems to be settled. The authors found that a whopping 56% of ERC20 tokens listed on crypto exchanges in 2021 had evidence of insider trading, including on major crypto exchanges. This is to be expected considering all the insider trading lawsuits we've seen since then, not naming names. What's crazy is that the authors seem to have identified a sort of insider trading cartel. 51 interconnected wallets seem to be responsible for most of the insider trading after these tokens listed on major exchanges. What's annoying is that the authors don't say which exchanges they analysed. If you're wondering what the authors counted as insider trading, well, the answer is any wallet that repeatedly bought a token a few days or hours before it was listed on a major exchange. What's interesting is that the subsequent insider trading was done on DEXs, not SEXs. Now, there were only a few cases where members of this insider trading cartel sold their tokens on the exchanges where the tokens listed. The authors suspect this is because these insiders were concerned about being flagged by insider trading detectors on these exchanges. Well, glad to know that they have these things anyway. Anyways, the authors go on to provide a case study of one insider who traded 14 listings using DEXs and 22 more using SEXs. Funnily enough, this insider trading wasn't nearly as lucrative as you might think. The insider spent $2.7 million to earn an estimated profit of $300,000. Should have just hodled. Now, in all seriousness, this large amount of working capital suggests we're not dealing with a run-of-the-mill retail investor here. We are likely dealing with a wealthy individual investor or an institution, possibly even a seasoned criminal. If your name is Sam Bankman-Fried, then you're allegedly all of the above. Sorry, couldn't resist. Now, another interesting finding in this case study was that the supposed insider converted all of his or her ill-gotten gains from USDC into USDT. This suggests that the wealthy individual, institution, or seasoned criminal in question is operating somewhere offshore, i.e., not in the United States. Alternatively, it could just suggest that the entity in question is concerned about having their ill-gotten gains frozen by Circle. For those who don't know, stablecoin issuers can freeze your stablecoin holdings. Tether has actually frozen more stablecoins than Circle, which makes the USDT swap seriously odd. Speaking of which, if you want to make sure you're not losing extra money with every trade, check out the Coin Bureau deals page. It's got up to $40,000 of airdrops and bonuses in addition to the biggest discounts on trading fees. The link to that will be down in the description. In any case, the authors speculate that the entities in question are token issuers, market makers, or investment firms, not far off from the kind of folks I mentioned a few moments ago. What's fascinating is that the authors identified 54 additional wallets these entities created specifically for insider trading. As you might have guessed, That's because most of the transactions going to or coming from these wallets are related to tokens that are about to list or have just listed. And the authors note that the entities that control these wallets have used multiple methods to try and cover their tracks. These include privacy protocols like Tornado Cash, smart contract-enabled privacy coins like Secret Network, and crypto exchanges that don't enforce KYC. As it so happens, we covered Tornado Cash and Secret Network in a video a couple of years ago. It's in the description if you're interested. Boy, does time fly. Now, in their analysis, the authors speculate that there's a fourth entity that could be engaging in insider trading, and that's the crypto exchanges themselves. Now, this is an accusation that's been levied against select crypto exchanges in the past. Obviously, not going to name names here. Now, to their credit, the authors admit that some of these wallets could just have been lucky. From our perspective, it's also possible that there's just a handful of entities that are doing the insider trading, and the other wallets are just copy trading. You've probably seen threads about these wallets on Twitter. Sorry, I mean X. Anyhow, what all these wallets have in common is that they seem to have had access to material non-public information, or MNPI. From the author's perspective, only token issuers, market makers, investment firms, and crypto exchanges have access to this kind of information. Then, in the next section of the report, the authors discuss DEXs, which they refer to as being, quote, game changers for insider trading. Not surprisingly, the authors found that the presence of DEXs seems to increase the frequency of insider trading due to the pseudonymous nature of DeFi. To put things into perspective, the authors provide some statistics. Insider trading before earnings announcements for publicly traded companies happens around 5% of the time, and insider trading before mergers and acquisitions of publicly traded companies happens around 20% of the time. You'll recall that insider trading for crypto is 56%, and that's just for ERC20 tokens. Insider trading for crypto tokens on other blockchains could be higher. Note, though, that the authors do not note this, but the presence of DeFi whales on some blockchains suggests that this is in fact the case, not naming names. Regardless, the authors seem to give a warning to these insider traders by reminding them that blockchains may be pseudonymous, but they're publicly viewable and all transactions are traceable. They imply that they'll hunt down the insiders using their advanced blockchain analytics platform. On that note, if you're wondering how blockchain analytics companies track your crypto transactions, be sure to check out our video about that using the link in the description.
Sorry to interrupt you folks, but I have to let you know about the Coin Bureau deals page. Now, my team and I have been able to pull together some of the best promos and discounts in the crypto space. We're talking trading fee discounts of over 50%, thousands of dollars in bonus airdrops, amazing deals at top exchanges, reduced prices on hardware wallets, and much, much more besides. So just go to coinbureau.com/deals, also linked to below, and find the promo suited to you. Enjoy the rest of the video.
Anywho, you'll hopefully recall that the second part of the report pertains to wash trading. Now here, the authors start with a few eye-opening statistics. Since 2020, liquidity providers on Ethereum have wash traded over $2 billion of crypto. Again, that's just on Ethereum. Imagine the other chains. And consider the other numbers. 20,000 tokens, wash trading in 67% of over 30,000 liquidity pools the authors analysed, wherein wash trades accounted for an average of almost 15%. And if that wasn't bad enough, the authors believe that the amount of wash trading on DEXs on Ethereum is even higher. That's because all of this wash trading only accounts for 1% of the data the authors analysed. Now, if you're wondering what wash trading is, the authors explain it perfectly. Quote, wash trading is a form of market manipulation in which one entity simultaneously buys and sells the same asset, creating a false impression of market activity despite the trade reflecting no change in beneficial ownership. Basically, trading with yourself. As with insider trading, there are a few known offenders when it comes to wash trading. These include centralized exchanges, crypto market makers, individuals, especially in the case of NFTs, and token deployers, aka the team. Gotta love that teamwork. The authors then point out that wash trading on DEXs is extremely expensive due to on-chain fees, but can nonetheless be profitable. That's because wash trading on a DEX increases the chances of a centralized exchange listing, and that makes it possible to do insider trading. To drive the point home, the authors then unpack the two types of wash trading on DEXs. They're actually pretty straightforward. The first type involves providing liquidity and swapping using one wallet, whereas the second type involves multiple wallets which are often controlled by the same entity. The authors estimate that under half of the wash trading is done using just one wallet, and just over half of the wash trading is done using multiple wallets, in case you were wondering. Now, as with the insider trading, the authors provide a case study for the wash trading, and they pick an easy target, SHIB Farm. According to the authors, quote, "It had no website, roadmap, or public offering to credit for the rally. Instead, its creator relied on investor FOMO about a similar meme coin's rapid rise. The week before, Shiba Inu, SHIB, had rocketed 2,500% almost overnight." Ah yes, the good old days. Note that you can find out how to spot a shitcoin using the link in the description. I digress. But back to SHIB Farm. Now, whoever created the shitcoin used two tricks to pump its price. The first was to make it impossible for new buyers to sell, and the second was to use a network of wallets to give the impression that there were multiple buyers FOMOing into, quote, SHIB's second coming. The authors estimate that the fake dog deployer tricked a total of 50 traders into FOMOing in and made an estimated profit of over $2 million. Now, logically, this means that these 50 traders weren't exactly retail investors either, and I, for one, would absolutely love to meet whoever has millions to throw at obscure meme coins. Anyway, here is where things get spooky. According to the authors, whoever created SHIB Farm went on to create 50 additional shitcoins, including Shiba Swap. Now, it's unclear if this is the same Shiba Swap that's now being used by thousands of Doge-obsessed traders. It would be really nice to get clarity on that one. Concerns aside, the authors go on to explain that wash trading in DeFi is both detectable and preventable. They argue that DeFi protocols could implement similar technologies to those used on centralized exchanges to stop wash trading. On-chain analysis can also identify suspicious liquidity providers. Now, this all brings me to the big question, and that's what all of this means for crypto. Well, the short answer is that it's not good news for DEXs. Come to think of it, though, it's rather surprising that the report focused exclusively on insider trading and wash trading on DEXs when it appears to be more common on SEXs. If you watched our video about the analysis Forbes did about sketchy trading volume on centralized exchanges, you'll know that up to 50% of BTC trades on exchanges are fake, at least according to Forbes's rather questionable criteria. To be fair, this is an improvement on the 95% figure they found back in 2019. However, this report and the one done by Forbes reveal something that's much bigger than fake trading volume, wash trading, or insider trading, and that's bias. Both reports seem to have a slant to them, and neither of the two seems to be perfectly accurate, though Solidus Labs did do a good job. In the case of the former, it seems to imply that DEXs are hotbeds of market manipulation, while in the case of the latter, it seems to imply that centralized crypto exchanges are hotbeds of market manipulation. Clearly, both have an invisible hand in the crypto market, but DEXs are arguably the lesser of the two evils. That's simply because all transactions on DEXs are publicly viewable and therefore traceable. Sure, we still don't have the tools to identify every malicious actor on-chain, but innovative crypto analytics companies, such as Solidus Labs, are working hard to build these kinds of solutions. To crypto analytics companies, centralized crypto exchanges are a black box, however. Once a coin or token is sent to an exchange wallet, there's no telling where that money goes or doesn't go. Only exchanges have that data, and if you're dealing with an offshore exchange, chances are that you can't verify where it went. This is why you could argue that DEXs are, or rather will be, even less prone to market manipulation than centralized exchanges in TradFi markets. That's because transparency is a better regulator than a small group of people who are often bought and paid for by the entities they're supposed to be regulating. As the authors of today's report pointed out, in DeFi, there are ways to apply regulations at the smart contract level. This is a bigger deal than you might think, because the fact that these regulations are on-chain means that you can easily verify which DEXs are safe and which ones are not. In case you missed the memo, Ethereum developers are working on exactly this kind of technology. Developers on blockchains like BNB have gone one step further by adding this functionality to the blockchain level. Of course, both technologies come with their own sets of concerns. The key takeaway is that DEXs in crypto are slowly but surely finding ways to mitigate market manipulation. The same is true of CEXs. Meanwhile, in TradFi, the fines for market manipulation have effectively become a cost of doing business. Look no further than JP Morgan for evidence of that. Now, of all the issues that crypto has, market manipulation is one of the most solvable, and it's one that will be solved sooner than people think. Once that's done, it will quickly become apparent that crypto has much bigger issues that must be addressed, such as centralization, privacy, and censorship resistance. Most crypto projects and protocols fail on all three of those metrics. Some would say it's about time that we started making more reports about just how bad these issues are. Hopefully, cutting-edge crypto analytics companies like Solidus Labs will lead the way. And that's all for today's video. If you found it informative, let us know by smashing that like button. If you want to make sure you stay informed, subscribe to the channel and ping that notification bell. If you want to help inform others, be sure to share this video with them, assuming they want to see it, of course. And if you've been accumulating your favorite coins and tokens throughout the bear market, make sure you're maximizing your gains by using exchanges with low fees and keeping your crypto safe with wallets that hold your private keys. The Coin Bureau Deals page has up to $40,000 of bonuses and airdrops on the best crypto exchanges, as well as the lowest fees in town. It's also got the biggest discounts on the best hardware wallets and even metal seed phrase wallets that you can use to recover your digital gold. The link to that will be down in the description. Thank you all for watching, and I'll see you next time. This is Guy, over and out.